All right, let's dive into some of the most powerful advice from Benjamin Graham's classic, The Intelligent Investor. Today, we're talking about investment funds. You know, the main way most of us actually try to build wealth.
So let's start with a question that kind of flips the usual script on its head. What if the real secret to getting rich isn't about picking the single best investment? What if it's just about avoiding the absolute worst ones? This one idea, it's the key to everything Benjamin Graham taught about funds.
You know, for most of us, buying individual stocks is a huge challenge. I mean, to get properly diversified, it feels like you need a ton of money and a PhD in finance just to get started. So what's the simple way around this?
Well, that brings us to a really basic question. How on earth can you own a piece of hundreds of different companies, even if you only have a modest amount of cash, say $1,000? This is the exact problem that investment funds were invented to solve.
The concept itself is beautifully simple. The best way to think about it is like a team sport. Instead of trying to play the whole game by yourself, you pool your money together with thousands of other people, and together as a team, you hire a professional coach, a fund manager, to make the plays, and then everyone shares in the wins or the losses.
And this team approach, it has some massive advantages. For starters, you get instant diversification. You own a tiny slice of tons of companies right away. And because all the expenses are spread out, it's way cheaper than trying to buy all those stocks yourself. Plus, you have a pro who's supposed to be making all the big decisions for you. But, and this is a big but, not all funds are created equal. Graham pointed out a really critical difference between the two main kinds, open-end funds and closed-end funds. And understanding this difference can be like choosing between paying full retail price and finding an incredible bargain.
So the difference really just boils down to how they're built. Open-end funds, which are what most people think of as mutual funds, can just print up new shares anytime someone wants to invest. But closed-end funds? They have a fixed number of shares, and those shares trade on the stock market all day long, just like a share of Apple or Google. Now that might sound like a small detail, but it has a huge impact on the price you pay.
And here it is. This is the critical difference for your wallet. With a lot of those common open-end funds, you actually pay a premium, something called a sales load. That means you could be starting your investment already down a few percentage points. But Graham found something amazing with closed-end funds. Because they trade on the market, their price can sometimes fall below the actual value of all the stocks they own. Think about that. You could literally buy $1 worth of assets for just 85 or 90 cents. That's an incredible head start. Okay, so you hire these professional managers, you pay them fees, you'd expect to get amazing results for that, right? Well, this leads us to what might be the biggest myth in the entire fund industry, and it's a major plot twist. I mean, seriously, with all their research, their teams of brilliant analysts, and their supercomputers, do these highly paid experts actually manage to do better than a simple market average?
The answer, based on decades and decades of data, is a shockingly simple and kind of humbling no. On average, the pros do not beat the market. In fact, the vast majority of them actually do worse.
And there are three main reasons why this happens. First, and most importantly, high fees. They act like a constant anchor, just dragging your returns down year after year. Second, as funds get huge, they basically become the market, which makes it almost impossible to outperform it. And finally, there's this constant pressure to post big numbers, which pushes managers to make risky, short-term bets that often just don't work out.
And that fee drag we mentioned, it is so much more powerful than it seems. Just look at this chart. See how a seemingly tiny difference in fees, maybe 1% or 2%, compounds over decades? It creates this massive gap in how much money you end up with. We're talking about tens, even hundreds of thousands of dollars that go to the fund company instead of staying in your pocket. So if most funds fail to deliver, how in the world are you supposed to pick a good one? Well, thankfully, Graham didn't just leave us with the problem, he gave us a clear, intelligent playbook to cut through all the marketing noise.
Graham's filter is just brilliant because of the order he puts things in. Step 1, the most important step by far, is to check the expenses. Just get rid of any high-cost fund right off the bat. Don't even consider it. Only after you've done that should you look at its risk level and the manager's reputation. And notice what's dead last on the list? Past performance. And this really gets to the core of his entire philosophy. You can't predict the future. Anyone who tells you they can is selling you something. But costs? Costs are a certainty. You know exactly what you're going to pay. So, it just makes sense to focus on the one thing you can actually control.
Graham's thinking was absolutely revolutionary for its time, and it led directly to what is maybe the single most powerful investment tool for the everyday person today, the index fund. You can think of this as the modern evolution of his big idea.
An index fund doesn't try to be clever. It's not trying to outsmart anyone or beat the market. Its only goal is to be the market by simply buying and holding all the stocks in a major index like the S&P 500. And here's the crucial part. It does this for a rock-bottom minimal cost.
And when I say the cost difference is big, I mean it's staggering. A typical active fund might charge you 1.5% a year. A typical index fund, maybe 0.1%. That cost advantage is absolutely enormous, and it compounds in your favor year after year after year.
You know, it's the classic story of the tortoise and the hare, right? If most of the expensive, actively managed funds, the hares, fail to even keep up with the market, then a cheap fund that guarantees you the market's average return, the tortoise, is, by definition, a superior performer over time. All of a sudden, being average becomes a brilliant winning strategy.
And this all leaves us with one final really important question to ask ourselves. The entire financial world is obsessed with this idea of beating the market. But Graham's wisdom forces us to ask something much more personal. Is your goal really to beat the market? Or is it just to meet your own financial goals? Because the answer to that question, well, it changes everything.